All right, let's get started. So once again, good afternoon. Welcome to the YD Wealth webinar. Thank you for taking your time to be here with us. We're super excited to put this on for you and share our thoughts on the markets as well as what we've been doing in the portfolios. So before I start, I do want to give you a bit of a preview in terms of the format as well as some housekeeping items. So this webinar is structured with two components. The first will be a presentation by myself, which will take about 30 minutes. And then we'll do a Q&A session with both Alan and I to address any questions you may have. Now, in terms of housekeeping items, I wanted to let you know that your camera and microphone are muted for privacy reasons, so we cannot see you and nor can we hear you. In order for you to interact with us, you can simply go up to the top right of your screen. You'll see a little question mark with a Q&A box. So if you click on that, you can open the Q&A chat box, and that will allow you to either type in a question or a comment and let us know what you're thinking, and we can then address your question or comment through that interaction. And by default, all questions or comments submitted will be submitted anonymously, so don't worry about privacy stuff. Now, I also want to let you know that this session will be recorded and will be sent out and made available to those who cannot attend today. So with that said, I would like to turn it over to Alan to make an introduction for us.
Hello, everyone. Thumbs up, Ethan, if you can hear me.
You're good.
Excellent. Well, here we are, the inaugural YD Wealth Partners webinar. This is kind of fun. I am noticing from our list of attendees that we've got people online from as far west as Oak Bay, as far east as Terrebonne, and as far north as the Yukon. So welcome to pretty much all corners of the country, and I will encourage you to use the chat because when Ethan and I say funny things, we won't have any feedback and I'll feel inadequate. So make sure that you use the chat to laugh at our funny jokes and things like that. All right, so most importantly, though, I just want to make some introductions. I, of course, am Alan Young, and for those that haven't seen me in a little while, because we usually do phone meetings, so I am bringing in some gray hairs, and that just tells you how long some of us have worked together as client and advisor. I have I've been working with Ethan for 3.5 years. We formed YD Wealth Partners. Y, Alan Young, stands for the Y, Ethan Dang stands for the D. We even sent out an email a couple months ago from YD Wealth Partners, and clearly we've been working too hard because we haven't put out that name enough for people to recognize it. So this is one of the first occasions where people are getting a good introduction after 3 years to YD Wealth Partners. And of course, YD Wealth Partners is a partnership under the banner of Richardson Wealth, our parent firm. Richardson Wealth shares, really the same goal as Ethan and I, and that's to provide the best possible wealth management that we can in Canada, and that covers all the aspects of finance, investments, of course, but financial planning, insurance, financial taxation. We cover it all, and we consider ourselves to be a holistic team of providing everything you need in finance. To do that, our team of Harpriya, Carmen, Ethan, and myself, we've been working hard in pursuit of that goal of best practices. And I guess that's the reason we're here today, is it's time to tell you what we've been up to, because I'm very proud of what we've been achieving. So logically, we should be talking about it. I'm proud of the services we're providing and our response times. I'm proud of our portfolios in wealth management. And I can tell you all that I sleep very well at night knowing that we have a plan for all market conditions, and including this current one. And so that's really why we're here today, to hear from Ethan on his view on how the tariffs have affected the markets, and then what we've done with your portfolios, to navigate these markets. So I'll pass it back over to Ethan to enjoy the what he has to say, and I'll be taking again. Just I'll be bringing the questions to the queue and seeing which ones are most popular to pose at the end of the session. Over to Ethan.
Thank you, Alan. I wanted to start us off by setting the context. As many of you know, our practice is structured such that Alan is the lead for relationship management and I'm the lead for money management, but oftentimes I'm behind the scenes. So I had suggested to the team, let's do a webinar and share our thoughts. And so really this was really a lot of planning behind the scenes, but really the purpose of doing this webinar is twofold. First of all, we are dealing with uncertain times in the market, so we wanted to provide some clarity with respect to what's happening in the markets, as well as what we've been doing for you in your portfolios. And secondly, it's a chance for you to get to know me and how I think about money management. So here are the key points. You can think of this as the executive summary for this webinar. With respect to the outcome, I'm happy to say that we have avoided most of the market pain year to date by proactively managing risks and playing defense. So a couple examples of defense would include we came into 2025 light on US equity exposure, so that has helped us avoid some of the drawdown. And we also, throughout 2024, shifted some of our US assets into international markets, so we were more diversified. And as a result, we're now looking on the other side of the coin, which is how do we play offense? How are we looking for opportunities to capture in this market with the volatility that we're seeing? And also I should mention that the other part is we were quite intentional in keeping more cash and money market in the models also coming into 2025. And so that's giving us, you can call it dry powder, a little bit of more leeway to play with in this volatile market. And with respect to the process, we don't have a crystal ball, but as you'll see, we sure have a plan and a structured process to navigate the markets. So here's our agenda for this afternoon. I'll share a little bit about myself. Then we'll go into an overview of the current markets, as well as our investment plan and process. I'll finish with some final thoughts, and then we'll switch to the Q&A session. So I often refer to myself as the chef in the kitchen within the team. And so I thought it would be fitting to share a couple of fun pics of myself. The one on the left was my time volunteering at the Ronald McDonald House, cooking a meal for sick kids and their family. And the picture on the right was just last year's Thanksgiving. So I want to take a couple minutes here to share with you my journey into money management before we get into the markets. So really my journey into managing money started in 2001, right in the midst of the tech boom and the tech bust. And at the time I had just graduated from UBC from the electrical and computer engineering program and had gotten a job at a company as a computer engineer at a company called PMC Sierra. It was a company that was in the semiconductor industry. So I was designing microchips, and collectively, people in my generation, we were building the backbone of the internet. And because of the work that I was doing and the industry that I was in, I was exposed to high-tech stocks, including my own company, NASDAQ, etc. So really, even a year before that, I started investing as a hobby. So I was dabbling in the markets, and very quickly, I learned a lot of lessons during the subsequent, the boom and the bust of the tech bubble. But what I discovered was that over time, it just became more and more interesting for me, and investing became a passion for me. So it got to the point where I thought to myself, well, if I don't follow my heart, I might regret this in life. So after a lot of thinking, I decided to reinvent myself. I went back to school. I did my MBA in finance, got my CFA charter, which I'll speak a little bit about later. But effectively, that allowed me to move into finance in 2011. And so overall, I've been tracking and studying markets for about 20 plus years now. And I have to say, I feel super blessed to be able to do the work that I love and also to help our clients protect and grow their wealth over time. So of all my training and education, I would say the one that is the most relevant to money management and the one that I'm most proud of is the CFA Charter. Some of you might know this, but if you don't, the CFA Charter is one of the most respected financial designations out there. It's often regarded as the gold standard in the investment industry. And in short, it requires about 10,000 hours of studying, exams, and work experience to obtain it. So I got my charter in 2015, and I've been practicing with it for about 10 years now. So now let's switch gears and go into current markets. Before I do that, I do want to remind you that we did send out an article titled Tariffs and Your Investments in early March. In that article, we started to share our thoughts on tariffs when it became quite evident that it may be something that was substantial. And so as a reminder, we did send it out through YD Wealth Partners as an email. So if you haven't seen it, you can certainly go back and search for YD Wealth Partners and search for this title. It's also available in the blog section of our website. And in the article, I concluded with a couple of thoughts that I wanted to just reiterate here. The first was that I said your portfolios are well diversified and well structured to handle short-term market turbulence. And then secondly, that volatility can translate into opportunities for us. These two comments were relevant in April because our portfolios were tested in April, and we were able to capture opportunities in the midst of the volatility, which you'll see in a bit. So with that, I want to dive into the meat of the presentation, let's call it. I will spend quite a bit of time on the next few slides, so I want to just walk us through slowly. So here we have a timeline of the tariff schedules. So you can talk, it's tariffs and trades, but I call it really a timeline of what happened. So what I'll do here is I'll walk us through these key dates quickly. Then I'll show you a chart of how the market reacted based on these significant events. And then I'll combine the dates and the chart together and give you a play-by-play of the market action, as well as the actions that we took in your portfolios through time. So let me start off by saying that on April the 2nd, as you may be well aware, reciprocal tariffs were announced on many different countries across the world, on top of the 10% baseline tariffs. As you can see by the table on the right, here's an example of some of the countries that were most affected, for example, China. And what happened was, because the reciprocal tariffs that were announced were a lot bigger than most people expected, the markets sold off quite heavily for the next few days. And it wasn't until April the 9th when there was a 90-day pause announced for pretty much all the countries except for China that the markets had a reprieve rally or a bounce. In fact, China, the tariffs on China escalated to about 145%, and so it seemed like it was really unsustainable, but it was just the back and forth retaliatory tariffs between the US and China at the time. So the markets were certainly really worried about that. And then at the turn of the month, on May 8th, we had a small deal done with the UK, but it wasn't as significant, so the markets didn't really pay much attention to that. But on May 12th, it was announced that China and the US decided on a 90-day pause on the reciprocal tariffs with each other. And that allowed the rally to be sustained and continue. So really, the key dates I want you to remember here are April the 2nd, April the 9th, and May the 12th. So now I'll show you a chart with these key dates and how things played out. So here I have a one-year chart of the S&P 500, which is the US broad market. It's the most liquid and the biggest market in the world. Now, for those not familiar with reading charts, this might seem a bit like a spaghetti to you. So let me just take a minute here to orientate all of us, and so we're on the same page. I'll start with saying that at the bottom, on the horizontal axis, you have the dates, and on the vertical axis, you have the price or the level of the S&P 500. Each bar on this chart is 1 day of price action. A bar that is green means it's an up day in the market. A bar that's red is a down day. So as investors, we obviously want to see a market that moves in, from the bottom left here to the top right over time. We want this type of action. For the purposes of this discussion, you can ignore these blue lines here and the yellow line here. Those are more for analysis purposes. What I want you to focus on are the 3 dates that I mentioned and the text in the blue boxes. So now let me combine the 2 together for you because it makes a lot more sense to look at them together. And I will now step through the price action, and really the point of doing this is to show you almost like a day in the life of Ethan or the chef in the kitchen, or in the broader sense, YD Wealth Partners, because we spend a lot of time on your behalf tracking the markets and doing our best to manage risk and capture opportunities. So this slide really encapsulates that, and so I want to spend a bit of time to give you a play-by-play. So I want to start by saying that coming into 2025, we were positioned conservatively, so that has helped with playing defense. But as you can see from this chart, the markets actually started selling off in about mid-April because there was some initial tariff news that came out. So given that the market is a forward-looking machine, it looks forward and it starts to price in negative news. So we saw that market started to weaken starting in mid-February. And then the sell-off accelerated right after April the 2nd because of the reciprocal tariff announcements. And you can see by these heavy down red bars that there were 3 days of extreme selling, leading us to April the 7th, which is the last red bar that you see here. So really, the market didn't take the reciprocal tariff announcement well, and it was caught off guard. So it sold off very quickly. And it wasn't until April the 9th, when the pause happened, the first pause happened, that we had this huge rally. It was up about 10% in 1 day to reverse some of this loss. So you might ask, what caused the US administration to pivot and provide a pause? Well, my observation at the time is that it's due to market forces. In the event leading up to the 90-day pause on April the 9th, what I observed was that during these 3 red bars, the market was telling the US administration that if you're going to play this game, we're going to pull money out of your country. So there was a flight of capital in some sense away from the US. And we saw it through the selling of stocks, the selling of US bonds or treasuries, you can call it, and the US dollar. So basically, I think the US administration acknowledged the fact that the market is voting with their feet and wallet, and there was money leaving the country and showing a lack of confidence in the US administration. And hence, they blinked and they paused the reciprocal tariffs. And as a result, we've seen a pretty heavy recovery and a bounce. And then obviously on May 12th, as I alluded to, the second pause between just the US and China was announced, and that has allowed the market to maintain this rally. So that's the market action. Now I'll give you a sense of the events and the actions that we took on your behalf. I want to start off by saying that we always speak a lot about the S&P 500, although we invest globally. So in your portfolios, we're investing around the world for you. But oftentimes we use the S&P 500 as the proxy for analysis because it is the bellwether market. It's the biggest and most liquid in the world. So many investors watch it and analyze it as a risk on or risk off type of indicator for the rest of the world. So with that said, I have really 2 pieces of good news for you. During this drawdown, of about 20% in the S&P 500, we observed that our portfolios were down only about 1/3. So we were only affected by 1/3 of the decline of the S&P. So that's really good news. That's a sign that our portfolios were able to protect capital for you. And then on the flip side, we started buying actually in March because it was already a bit of a discount, but we accelerated our buying in various portfolios that we run in April. And in particular, on April the 7th, right at the bottom of the market, we bought equity across the book and continue to buy into the recovery that you're seeing here. A few examples. In some cases, we sold a balance fund and we bought an all equity fund. In some cases, we sold bonds and we bought equity. In other cases, we use cash or money market and we bought equity. So in those types of instances, we were able to benefit and provide a faster recovery that we've experienced over the last few weeks. Now, I have to acknowledge that in real time, we certainly didn't know that that was going to be the bottom of the market. We don't have a crystal ball, but what we do know is that at that point, the reward to risk was very favorable. So it was time to take some action on your behalf. So in essence, it's not about predicting the market. It's more about having a plan and a process in place to handle different market scenarios. So in fact, I always say that good money management is about first having a plan that allows you to assess reward and risk in a measured approach. And then you want to monitor that plan closely and pull the trigger when it's the right time to do so. So overall, we are happy with the recovery that we're seeing so far across the portfolios. And if the markets were to dip again for more tariff-related news, we still have other levers that we can pull. So we will be able to handle that situation. But right now, we'll take what we can get, which is a strong recovery. So I did mention that we invest globally, so it's only fitting that I show you the charts for a couple more markets. So here I have a 1-year chart of the TSX, which is the Canadian market. You can see here that the Canadian market did fall quite a bit as well, but it has recovered really well. In fact, more than the S&P 500, and partly in part helped by gold, because the TSX has a bigger exposure to material and gold. And similarly, here's a 1-year chart of international markets. Similar story, fell quite a bit, but has recovered pretty much all of the drawdown. As I alluded to, even in the tariff article that we wrote in March, we believe in international markets and we have shifted to that throughout 2024. And the good news is our model has quite a bit of Canadian and international holdings, so we're actually buying more Canadian and international securities in this recovery. So you might ask, well, we're just seeing 90-day pauses, so what really is the tariff endgame? My current read is that I think some form of baseline tariff is here to stay. The US administration really has stated two big goals, and they want to use some of the money from the tariff proceeds to support their goals. The first one being they do want to reduce the US budget deficit and their national debt over time. And the second is they want to use it to fund tax cuts of some form. So the key question then becomes, can the global economy handle baseline tariffs? And so far, the market is saying yes, as evidenced by the market recovery. It's basically saying that any negative impact from the tariffs could be offset by tax cuts, less regulation, and future interest rate cuts. And overall, the economy and corporate earnings remain resilient so far. So then in review, our plan has two parts. The first part being defense. We came into 2025 positioned conservatively, as I mentioned, and so that has worked well to protect capital. And now part two is about offense. So we've taken action and we'll continue to look for opportunities to buy at a discount. And I also believe it's a favorable time for sidelined cash. So if you have any idle cash, whether sitting at home, under your mattress, or at your bank, it's a good time to think about deploying it over time. And we'll certainly, we're happy to chat with you about it, and we can come up with a plan to roll the cash into the market as volatility continues. So now I want to switch gear and give you a brief look underneath the hood with respect to our process. We won't have time to do a deep dive today, but what we will do is do a more in-depth presentation on the investment process itself in the fall. So we'll schedule another webinar for that, probably in September or October. But in essence, our process is to apply an institutional approach and mindset to creating and providing you with globally diversified multi-asset portfolios. So in simple terms, that just means we invest your money globally and in different assets, with stocks and bonds being two examples. And these types of portfolios form the core asset mix. And as you can see, or have seen, the portfolios that you have give you the benefit of protecting capital during market turmoil, but allow you to participate in market upside over time. And around the core asset mix that we have for you, we are actively looking for opportunities. And when we see them, we place tactical trades to capture those opportunities. And we do this through a portfolio management tool called InvestNet. InvestNet is a tool that our firm Richardson Wealth has invested millions of dollars in to equip us with the ability to plan and take action quickly in the markets. And because of my engineering background and training, I've been using InvestNet heavily and have become a power user of the tool. So I want to give you a visual example of what an institutional portfolio would look like. And this is something that you have in your own investments. But a few things to note. First, I want to caveat to say that this is not an all-inclusive example. Like I'm showing you many different types of assets that could exist in an institutional style type portfolio, but certainly there are many more assets that exist out there. But this is a pretty good example of what you could see if you look underneath the hood for institutional style portfolios. A few comments. The first is that many individual investors really only know about the left side of the circle. Most people know about real estate because they own a home. They'll know about stocks, they'll know about bonds, but very few know about the assets on the right. And more importantly, they wouldn't have access to it. In fact, if you go to the bank and buy a bank balance fund, you're really only getting access and exposure to two slices of the pie, stocks and bonds for the most part. But in your portfolio with YD Wealth Partners, we're giving you exposure and giving you diversity through many of these different types of assets. So that's really just a brief overview. And as I mentioned, we'll do something more in depth in the fall. So in closing, I want to reiterate that your portfolios are well diversified and well structured to handle market turbulence, as you've seen. Despite all the negative sentiment surrounding tariffs, it is our firm belief that, like all past episodes of market turmoil, this too will pass. And if we embrace volatility as part of investing, we can capture the opportunities and reap the rewards of long-term growth. So with that, I would now like to invite Alan back in and have him join me to answer any questions you may have in the Q&A session. And as a reminder, feel free to open the little chat box in the upper right corner with the little question mark. If you open it, you'll be able to enter your questions or comments anonymously.
Thanks, Ethan. Super informative, and I hope everyone took a lot from that. Seeing some questions start to come in. One that we've been actually getting from many people prior to this webinar today, as we've been speaking to clients and we've been receiving calls. Of course, people have had concerns. Ethan, I'll pose this to you and you can comment, but the first question that's been posed in the chat is, do you think that the tariffs will result in a recession?
Yeah, that's the big question of the day. It's certainly a valid concern. The short answer is the potential for a recession has increased, but there are currently no imminent signs of a recession. So let me elaborate a little bit. I think first let's define what a recession is so that we're on the same page. So a recession is defined as 2 consecutive quarters of negative economic growth. And so if we look throughout history, there are really 4 major factors that cause recessions. The first is high interest rates. The second is high oil prices. The third is high unemployment. And the fourth is some form of deleveraging in the markets or a bubble of some sort. So I can say that right now, none of those exist. There's potential for them to exist, but none of them exist. And so I guess if we play out the different scenarios, we can say that, given the tariffs are in flux and uncertainty is high, in the scenario where tariffs remain high, certainly, inflation could end up being high and unemployment can end up being high. So that could certainly lead to a recession down the road. In the other scenario where trade deals get struck and things get dissolved, tensions get dissolved, then really a lot of the damage that we've seen can get reversed very quickly. And so my take is, what is the market saying? Because you can have an opinion, I can have an opinion, but ultimately it's the aggregate opinion of the market that determines what your portfolio is actually doing. So right now, as evidenced by the market's recovery, the market is basically saying that it thinks trade deals will get done and is not signaling a recession. And so that's our current stance, is there is potential, but no real red flags of a recession, and the market is saying that as well.
Ethan,
so Alan, back to you.
Yeah, can you hear me, Ethan? I've got a few more questions in the queue. Okay, so next question, it's a good one here, is from Anonymous, they all are. Do you think that the US dollar will continue to be the default world currency? So before I pass it back to Ethan, let me just define this a little bit. By default world currency, this question, the person asking this question, it really means something quite annoying, actually, and it's really when something I've observed my entire career, 27 years, is that when the markets truly get in a bad mood, the US dollar goes up. It's really what it is a flight to liquidity. People just want to get liquid, and the most liquid investment in the world is the US dollar. And it is annoying because, as Canadians, what we end up seeing is the US dollar going up, and of course our Canadian dollar going down, and things like gold going down and oil going down when the market is worried. And so the question is a really good one. Ethan, let me pose it to you. Do you think that the US dollar will continue to be the default world currency? And I suppose the question could be separated between short term and long term.
Yeah, it's another great question. In the short term, my answer is yes, it will remain as the default world currency. Things like that, when you're in the incumbent currency, so to speak, it does not change overnight. It takes sometimes decades for shifts like that to happen. Now, over the long term, if they keep playing this tariff game and they lose global trust from trading partners and other countries, I can certainly see more and more people shifting away from the US dollar and going into other currencies or gold or Bitcoin. I know, like, Bitcoin's super volatile, but we can certainly see that there are more and more people embracing things like Bitcoin and going to gold. So I guess, yeah, in short, no for the short term, but potential. Once again, it's potential for the long term, but really many things can change from now into decades later.
Okay, I think we have time for one last question. I had hoped to keep in respect of everyone's time this afternoon. We're approaching 45 minutes, so we'll do one more question here, and then I think what I will state is I have noticed, excuse me, I have noticed that a few questions are to do with individual client. Of course, you're all clients, and you're asking about your individual portfolios. Things like how much gold is in your portfolio. Please pose that question to me personally, and I'll let you know what your holdings are. Generally, we'll use gold as a tool from time to time, but depending on your model, that's a more specific question to each client. So here's the final question I think we'll pose for today before we sign off. Are the tariffs likely to impact interest rates in any way? And of course, interest rates are hard to predict. There's many different factors, but Ethan, what do you think the impact of the tariffs might be on interest rates?
Yeah, so another great question. So the US Federal Reserve, led by Jerome Powell, is currently obviously watching the markets very closely and what's happening with tariffs. And it really can play, once again, in two different ways. If in the scenario where tariffs remain high, it's going to drive inflation higher. In that scenario, central banks really cannot afford to cut interest rates. They might hold it. They have no choice but to keep interest rates higher to fight inflation, as we've seen like in 2022. We saw exactly that. In the scenario where deals get made and the tension in trade gets dissolved over time, then the central banks, like the US Federal Reserve, then can proceed with cutting rates as they had actually planned for 2025. So in fact, currently, I did some looking before hopping into the webinar. I can see that currently the futures market for interest rates is pricing in 2 cuts still for the US. The first one being 25 basis points in September and another 25 basis point in December. So really, the market is still saying that despite all the tariff announcements, the US Federal Reserve is still on course to cut twice for this year. And that's partly because the underlying economics and the fact is that inflation is coming down without the tariffs. And so that allows the US Fed to ease and give the economy a little bit more support. So I'll end it there. Oh, I think we have another question, actually.
Ethan, this question was too good to pass up, and we'll be quick with this one. If the exposure to the US market is lowered in our portfolio, what other world issues are you currently watching? Things that are relevant to perhaps both move the markets up or down in the next little while. I think that's a great question. Outside the US, what are the factors that you're watching?
Yeah, so I guess the most obvious one is just the tariffs and the deglobalization, so to speak, right? So if I was to look into Europe, into Asia, it's everyone's really focused on tariffs and trade deals. So that's number one. Beyond that, we've been watching Europe in the sense that they are trying to increase their fiscal spending through their defense budget. They've been lowering interest rates. So in fact, as you've seen in that international chart where Europe is a part of, that market has recovered very, very well. And in fact, the German DAX has made an all-time high recently. So money is flowing into international markets because of the stimulus that they're putting on in their own region. And then with respect to China, we all know that, you know, for them, their property market has been a drag on the economy. It's caused a lot of pain for their country and the consumer over the last number of years. And that has caused their stock market to suffer, and some of their tech stocks, in fact, to be trading at a huge discount. So they were down like a good 70–80% over the last few years. And that actually is part of the reason why, as alluded to in our tariff article in March, that we began to pivot a little bit from away from US technology and going into Chinese technology, simply because the valuation's too good. And also the Chinese government, despite all their issues, is also doing the same thing. They're trying to stimulate their economy through both monetary and fiscal stimulus, meaning it's the central bank cutting rates and also the the government trying to spend money in a fiscal way to boost the economy. So I think overall, my whole takeaway for you is, prior to the tariffs, the global economy was humming along quite fine, and it was going to continue to grow. And we still believe overall that we are in a secular bull market, which could last for a number of years. So that's been our thesis based on demographics, and that's been the price action support, meaning the market is telling us that in terms of feedback, until the tariffs came and gave us curveball. So really, that is going to be the wild card in the short term. And hopefully it gets resolved, but if not, we'll just keep playing defense and selective offense. So I'll leave it there and pass it back to Al now, maybe for some closing remarks, and then I can also jump in as well.
Absolutely. Yeah, no, I'm going to say that's where we're going to end off. This has been really fun. I do want to send a special thank you to both Ethan and Harpriya, who worked very hard to get this ready today. Sorry if there was any sort of speed bumps that you noticed along the way. First time for us using this program, but it seems like it's functioned. I did have a couple of clients say they did have some problems with sound, and it's disappointing. We'll send the recording to those people. Also, on a couple of questions that I noticed that we couldn't answer today on the chat, they did come to me anonymously, so please email me directly because I don't know who they came from. And yeah. In closing, our emails and our phones are always on, so if this has prompted any questions, feel free to call or email either Ethan or I. I'll say good evening for now. I'll pass it back to Ethan, and have a good night, everyone.
Thank you, Al. I just wanted to say thank you as well for spending your time with us. And I hope that you've gotten to know your chef in the kitchen a little bit more today in terms of who I am, as well as how I think about money management. I'm excited to hear any feedback that you may have for us, so please send us a note or give us a call. And we look forward to seeing you again in another webinar in the fall to talk about our investment process. With that, have a great evening, and thank you once again for your time. Goodbye.